Hello, everybody. Welcome back to Transmission. Today, I'm talking to Tommy Ricketts, CEO and founder at BeZero Carbon. So if you've ever looked at the carbon market or carbon credits and wondered, how does this even exist? And is it just greenwashing? BeZero is building the infrastructure to answer that question. So just like S&P and Moody's are credit ratings companies, BeZero is a carbon ratings company. So they assess whether a reforestation project in Colombia or a plant in Iceland or a mangrove restoration in Kenya is actually removing the carbon it promises. So we talk about how the carbon market works, why price and quality don't necessarily correlate, and what it's like to build a business that shines a light on an industry with a lot of hype, but a lot of cynicism around it too. So if you're curious about how the trillions needed for climate solutions are going to flow and how we can make sure they land with real impact rather than false promises and slide decks, this conversation is a must. Tommy is an excellent guest, really knows his stuff. And what I most enjoyed about the conversation was the fact he was upfront and honest. He does not dodge the tough questions. All right, we might as well get stuck in. Here's Tommy Ricketts from BeZero. All right, Tommy, welcome to the podcast.
Thanks for having me.
We are sort of cousins, right? Because Molten are investors in your business and investors in Modo Energy.
Yeah, I mean, I had a LinkedIn message from my investor at Molten in September 21. And by December, I'm going to make it up, but the 14th or somewhere around then, they'd given us a term sheet for our Series A. And they've been part of my board ever since. So yeah, couldn't ask for a better investor.
Yeah, special shout out to Molten. So if you could, can you tell our listeners about BeZero? What is the problem that you solve in the world?
We are a carbon rating agency. What that means is there are these things called carbon credits. They're supposed to deliver a ton of CO2 avoided or removed. And people want to use them to essentially help offset or pay for the emissions that they're making. The challenge with these things is they are kind of like a financial asset. You can kind of buy them and trade them, and they kind of work like a commodity, and people sort of want to make a market of it, but you don't actually get delivered it. So it's just, you're never really sure how much carbon is in this thing that you're supposed to be buying. And yet you're trying to make this action, which is a kind of definitive action, that I have this negative emission, I'm trying to buy a positive outcome. And if I put them together, it's going to create mathematical zero. And so the problem at the heart of the carbon market is, how do I prove the impact that I'm having? And a carbon rating is our way of trying to say, well, look, there are these quite strict methodologies that you have to follow. There's a lot of science and very heterogeneous project types that you have to try to evidence, but it's all a probability, right? It's all a confidence interval. And if you think about it in those terms, a carbon rating is the extent to which we believe that, a ton is delivered, essentially. Then it's a lot easier to understand the risks associated with these things without the risks of these things fully undermining their very existence. So it's kind of like a third way, like either they're real or they're not real is a false binary, right? They're kind of real in lots of different ways. But then if you think about maybe, if I borrow money, I have a mortgage, right? And that's the bank telling me what they think the probability of me repaying that debt is. It's the same, right? There's a chance I default, there's a chance I don't. And that kind of risk-based approach, we think, is a way to square the circle of the integrity issue around, are they real, and everything that goes on with greenwashing, and at the same time build a language of risk which allows people to understand and invest and actually operate in this market at scale.
And BeZero calls itself a carbon ratings agency. And ratings agency is a phrase that everybody knows. A couple, there's obviously some bad press from the financial crisis and whatnot, but I think rating agency as a concept in the financial world is quite a familiar one. But then in carbon, what's the jump that you have to make between those two things?
You talked about us being cousin businesses. I think a carbon rating agency and a credit rating agency are probably cousins in that sense. They're not siblings directly. So the familial nature, to continue this metaphor, is that you're both trying to treat this as a risk instrument, trying to identify the fundamental, as in the key properties that drive its performance over time. Even doing that in the carbon market is basically starting from scratch, because just thinking about it in financial accounting terms, thinking about it in clean data sets, in the way you would go and do benchmarking and referencing and statistical distributions, all this type of thinking, which is standard stuff that even really quite simple investors in financial markets is like, a whole new level of Swahili when it came to the traditional sort of science and NGO places that this stuff came from. So you're trying to financialize essentially the way the analysis is taking place. That's where it's very similar to a credit rating agency, but the content is completely different. We're not looking at price to earnings ratios or, EV to EBITDA multiples or whatever it might be, right? You're looking at biomass in a dry forest ecosystem and whether or not you think the 10-year forecast of this, which is quite experimental science, is realistic and whether it actually achieves that over time. So the cousin element is the translation of science into a system of financial analysis that can then be essentially treated like any type of risk taking, and therefore it allows people to have confidence or at least understand how to price what they're actually being exposed to, which is the financial language way of saying, I want there to be lots of people investing in the global south and in nature and all kinds of new technologies. These things have experimental and quite heterogeneous types of behaviors and risks, but it's a good thing, we believe, to invest in nature and positive climate action. And, this is just the boring architectural side that you need to build in order to make that vision a reality and get hundreds of billions to invest in this.
So if I may, I'm going to come at this a bit like I'm a kind of a 10-year-old, and you can tell me whether I've been too simplistic, and then we can go down the rabbit hole. But let's say big corporate, a big data center owner operator or a big polluter in the world says, right, I want to offset some of my carbon. And I'm going to go and invest in a forestry investment or some sort of carbon offsetting scheme. And then they go, well, how do I know is this legit or not? I can spend millions, hundreds of millions on this thing, and I can, it's great for my investors and my publicity, but is this thing actually moving the needle in carbon? And then they come to you, BeZero, and say, all right, tell me how legit this is. Is there default risk? Is there, are they actually removing this carbon? Is that how this works?
Kind of. I mean, let's just start by saying sort of the basic building blocks. You need to understand a project life cycle to understand how we contribute to it. So a developer will be an organization that sees, wants to have a physical intervention in nature or build something from a technology perspective, which they think can have a climatic impact. And by monetizing that climate impact.
Just to ask you there, so what would be an example of these kind of projects?
Yeah, so it could be regrowing a forest. It could be what's called improved forest management. So you slow down the pace of logging and you actually have more growth in the trees over a longer period. It could be so it's more sustainable harvesting. You could have just deforestation avoidance. It could be mangrove restoration. It could be soil restoration. It could be huge amounts of agricultural practices, through to quite kind of innovative technologies like direct air capture, biochar, which is like a hybrid. It's kind of sort of basically putting organic matter, burnt organic matter onto the ground and locking the carbon in that way. It can be, all kinds of quite exotic ocean activities. And then, older times, it was things like cook stoves, where you replace basically charcoal with types of cooking fuel, stoves, or even renewable energy. And basically the whole idea is, by having this additional revenue associated with this activity, the intervention can take place, right? And so additionality, which is the extent to which you need the money to actually do the activity, is a big part of the carbon market. Lingo bingo, which is, it's sometimes a bit too oppressive, the lingo bingo in this market, but that's the essence of a carbon credit from another type of green finance. And all of those activities, you'd hope, by monetizing the climate impact, have a higher likelihood or have any likelihood of actually taking place. Now, that's the first thing, right? Is there an intervention from which setting the climate benefit would, therefore finance it? And then you've got investors who will say, okay, well, I'll give you the capital to do it. And they might want a financial return or credits in return. Then you have intermediaries, which can be transaction venues like exchanges and marketplaces, or it can be brokers like dealer brokers. And then you have the buyers. And the buyers, as you said, data center buyers who want to kind of offset some of their emissions. The thing that gets a bit tricky is the bigger players wear many hats. So, biggest clients will buy them for their own corporate footprint, will maybe invest in them for their own speculative or potentially future, return basis, and potentially trade them. Some of them even develop them themselves. So I think with that regard, as they start to deploy more money in this space, so that in other words, financial terms, they have more risk exposure, they care more and more about stuff like, how do I actually understand these assets? How do I understand these instruments? How do I understand the impact these things are having? So the first thing that a rating does is just try to explain it, all of these different types of activities in one coherent sort of system of analysis, language of risk, or whatever you want to call it, which is, three main risk drivers. Do you need the money to do the activity? Additionality. Is it actually having the impact it's saying it is? Carbon accounting, and it will be there. Will it be there for the time it's promised, which is permanence? Some people call that durability. And then we're going, okay, well, all of these characteristics are common. Doesn't matter if you're a forest in Zimbabwe or you're a DAC plant in Iceland, and they should therefore be comparable. That's the first thing you're doing. And then you're saying, well, a rating is essentially our overarching view on all of those components coming together and saying to what extent will they actually deliver against this claim. And what you're trying to say is really the evidence submitted by the project should fully evidence its impact. The same as a valuation of a stock should fully value the company appropriately. And if you think the price of the company is too high, sell it. If you think it's too low, buy it. In a bond, if you think that the price of your credit exposure is, you're riskier, then I'm going to offer you a higher rate of, higher lending rate to actually to lend to you. In carbon credits, it's the problem that we're originally solving, which is interesting, is that when that buyer, as you said, is coming in to go, how do I know if this thing is actually having an impact? The main transmission vehicle in all forms of capitalism, something that it's taken me my whole career to appreciate fully, but is the price mechanism. And when you're in there, you go and buy this thing, you're, as you say, data company X, you'd expect that if you paid $10, $50 or $500, the $500 one would be a hell of a lot better than the $10 one. The problem that we encountered when we started, and that's an area where we see the most impact of our rating, is there was no correlation between price and quality. And so the reason, before you could even start going, how do I understand the impact? Shouldn't the impact already be basically in the price? Because price is distribution of risk, and that's the information point that everyone uses. And so actually the whole system, the fabric of the way the market was exchanging and communicating and transmitting information hadn't been built yet, right? So a rating it's a psychology of analysis. It's a way of creating a language of analysis, but it's also about trying to revive the price mechanism as the main information transmitter in the carbon market. And actually, the weird thing about the carbon market, to finish this point, is the marginal cost of delivering the activity. So keeping a forest standing through to building some sort of futuristic technology is wildly different. And in most markets, like an energy market, like obviously, that you work in, kilowatt hour is a kilowatt hour. Cheapest to deliver, is cheapest to deliver. Wherever the market clears, if you can, whatever your price is below the market clearing price is your profit. Doesn't really work like this here. If I buy something for $20, maybe that's only cost 50 cents to create, right? And that's it's a steal for the people that have sold it to you, or they're making off like a bandit. Or my marginal cost of production is $500, and actually I've sold it to you for $200, and I'm making, it's still 10 times what the other credit is, but I'm losing money. But even weirder, the $20 one produced at 50 cents could be twice as good a quality. And then so it's just the whole thing wasn't really making sense. And that's what you're trying to kind of reestablish the sort of traditional ways of understanding and interpreting this space. So to go back to your question, the buyer, they'd come to us and say, well, first of all, have you rated this project? Okay. And you can get our ratings. They've been on, we've made them public since we launched, and they can get a freemium account and go, okay, have you rated, project A? Yeah. Oh yeah, good. It's interesting. It's a double B. right? So we think it's like a moderate risk, like it's okay, it's not great. Maybe it's got some good sides, some bad sides. Maybe it's just mediocre all round. And then they're going to go, okay, well, why do you think this? Oh, well, obviously that's where you subscribe. You can see all of the analysis that sits underneath that. Oh, okay, how does that compare to the other 5 projects that are similar in this region? Northern Colombia or whatever. Oh, it's the best. That's really interesting because it's not that high a rating, but it's the best of these types in that way. What are they doing differently? And how does that, and why? Oh, but I've actually just been offered a similar project in Peru and you've given it an A rating, but it's selling at $8. Well, obviously, buy the A1 at $8, right? Because that's much cheaper. All of this type of thinking, basically, believe it or not, wasn't really taking place. Each individual corporate was going to an intermediary. They would have in-house research teams who would say, this is the good stuff, right? But the old adage is Henry Ford, you can buy any model as long as it's black. You just sell your own book, right? That's the challenge with obviously intermediaries. It's not to say they don't do great work. It's just to say that obviously if I'm selling you from a list of 10, what's to say that I'm not going to say the list of 10 is the best? That's obviously the point of independent research. And then they go, okay, that's good enough. And when we first started, we found that some credits you could buy from some of these organizations trading on the exchanges for less than $1 and were available for purchase for corporates at $15. That's quite outlandish spreads, right? To use a financial term, that's pretty outrageous, right? And again, they should know through the rating, one, why and to what extent is this having an impact, and 2, how the hell do I decipher the price action in the market with a quality reference point or a quality benchmark?
Quick break. If you listen to this show, then you probably work in energy. And at Modo Energy, we're not just talking about the energy transition. We help our users to actually make it happen. All energy storage, solar and wind assets on the global balance sheet need to be valued and benchmarked. And that's where Modo Energy comes in. Our benchmarks and forecasts are transparent, bankable, and trusted by the world's leading banks, asset managers, utilities, and developers. So if you want to learn more, go to modoenergy.com. And if you want more content like this, sign up to our weekly dispatch newsletter. Enjoy the conversation. So before BeZero came along then, was there, obviously your play is partially a transparency play, right? You're shining a light on a market and what is turning into a commodity. In fact, I'm interested to know, is carbon a commodity? Yeah, how do you think about that? Shining a light on that. And that must expose all sorts of things, good and bad, in the market. You've alluded to a few of those things, but could you just talk a little bit about when you first shine a light on this market, what's the feeling you get?
Disclosure in the voluntary carbon market is actually not bad. I prefer the word disclosure often to transparency, but it's patchy. The quality of the data is quite poor, both language and numbers. It's very inconsistent. But actually, all of the criticisms and the foundation of my entire business and the people that also deliver carbon ratings and associated diligence products was based on the fact that a lot of that information was disclosed. So we had a starting point to go in. It's not quite the same as quarterly earnings, but we had a starting point to go in and read these very, very convoluted and long-winded reports that would be submitted to the accreditors and try to figure out what this project was actually saying it was doing, turn it into a system and language of analysis, and then repackage it as a rating, with our analysis overlaid it. So funnily enough, we would never have been able to get into this space if there wasn't actually half decent disclosure to begin with. And the irony with the compliance market, that's where governments are saying you have to buy them under our government-backed schemes, is that they're actually very opaque. So one of the funny things I think is like in the voluntary is about your compulsion to buy. So in the voluntary carbon market, you're not compelled to buy, people buy them voluntarily, but disclosure is mandatory at an accreditor level. In the compliance credit market, purchasing is compulsory, but disclosure isn't. So you have this weird way around where actually you'd think government markets would be better, but they're actually much more opaque and not necessarily better. So the first thing was just to say is that it wasn't actually that bad, the disclosure. It just was very, let's just say like herding cats to begin with. The second thing to say is, well, if you start to try to figure out how to assess these things and apply traditional rigor like benchmarks, distributional analysis, you remodel them and you do bottom up analysis of the same assumptions and you find that they're wildly different or they're very similar, confidence interval analysis, stuff like that. you actually realize that there is just a very large distribution. There's good, there's all right, there's less good, there's highly speculative. But the language that we prefer to use is that is a risk spectrum, as opposed to the more language of morality, which is like good and bad, which I think is a pervasive and often corrosive tendency amongst the environmental movement, which is to say that they use moral language when what you're trying to really do is get people to pay for their impact, and use much more dispassionate and less amoral language of just like, well, would you pay top dollar for something that's having very low impact? No, right? You wouldn't pay top dollar for a really low quality, super processed piece of food. So why would you expect to do that here? You're not calling that person that created the processed food immoral. You're just saying that that's obviously, that's rubbish in, rubbish out, right? So I think, anyway, so that was another thing that we were trying to do, was like, I'll give you an example. In the early days, people would project the impact of deforestation for up to 10 years before reassessing whether actually that projection was accurate. Could you imagine putting a couple of million or even more behind that thing, going, oh look, I'm really, really confident that this forest, was definitely under a threat and was going to be just, deforested, and these guys are doing a fantastic job to protect it. And the forecasting error could possibly be infinity. Obviously that's like, and then you don't check for 10 years. And this is like deep, super complicated ecological assessments using blends of like ground truthing, remote sensing, experimental like forestry analysis. And you don't reassess it for 10 years. You imagine the forecasting error. So like, irrespective of using the words of morality, you're like, you could say, yeah, you were fully greenwashing, or you could just go, you know what, this is a frontier asset with a very small amount of money that's gone into it, experimental buyers. The best thing you could say about them is that they're at least putting a price on their emissions and trying. And the project developers, well, they're at least trying to figure out how to build this thing and use some methodologies to do it. Like, for me, that's kind of cool. That's the way things get built. Or you could turn around and go, you were lying, you were just so, embellishing, you never knew. Sure, but I reckon none of them knew, right? And if you hand on heart, in the dark pantheon of their souls, they could not have for a second thought that they were going to be 100% accurate 10 years from now on a bunch of experimental data, nor should they be held to that standard, right? That's just, for me, that's like nonsense. But again, back to the sort of corrosive activity of the green movement, they're very, and I'm part of it, but we can be very self-flagellating.
And making objective things subjective for the short-term gain of getting an emotive response. But the long term is, as you say, it can erode. It can just make people think, oh, none of it's real, none of it's true.
That's easier, yeah. Just to make that point, there's the two wings of it, which is I shouldn't have to pay for environmental impact ever, and therefore I want to make everything. I want to discredit everything. Or there is there is just like literally puritanical agenda of, unless it's perfect, everything else is basically just rotten, which is also just nonsense. And so, you're kind of stuck halfway in between. You can never be pure enough, and you can never be, or you're basically on the wrong side of it because you're trying to make me pay for something I shouldn't have to pay for. So yeah, you're right. It's a real pickle. But this is like, this is a markets-based solution to try to actually get people to pay for emissions and create jobs and growth out of that activity, which really winds up a lot of people on both sides of that.
So I want to try and get my wording right here, and so forgive any clumsy language, but how do you find the challenge of a lot of, and you'll have the numbers better than me, but I mean, you talk about East Africa, for example, being a carbon market powerhouse, and a lot of the carbon removing or carbon market activity happens towards the fringes of the OECD. And sometimes in nations where the rule of law or the sophistication of the markets isn't necessarily at the same standard as what we were privileged to grow up with. And so how do you make those things all work out, operating in regions which much of the world, they don't have as developed capital markets, and therefore they don't have as developed legal systems and all those things. And if you're listening to this and I've upset you in the way I've described that question, then forgive me. But hopefully you know what I mean here, Tommy.
I'll give you an example of what you mean. There's only, the last time I looked, there's about 40 companies that actually issue bonds, and there's depending on how many you count, around 200 countries in the world. So 4/5 of the countries in the world are unable to issue debt as countries. So, to just use a financial way of explaining it, no one in the world trusts 4/5 of the companies to actually give them money to pay for their own sake, right? So that's another way of saying that. Yes, very immature and lower down or high in the corruption scales or low in the institutional development scales, any of those sort of economist indices sort of things. That's kind of the cool thing about working in an area which theoretically should lead to a massive wealth transfer from the global north to the global south, because the global south is rich in carbon assets, if you want to call it that way. And the global north is short carbon, very short. And, that's one of the most exciting things, particularly about the nature side of it, which is nature restoration and preservation should become an enormous multi-trillion-dollar industry, which should predominantly go from, back from the channels of industrial production, which have been, keeping the global north rich for the past 300 years. So that's really cool. But as you say, operating in countries that have bad rule of law, volatile policy environments, high corruption levels, well, what types of industries are expert at operating in those? It's the miners, right? And the commodity trading houses and the companies that have and sell global commodities and from extractive industries. So it's little wonder that, Vitols and Shells in this world are predominant players in the carbon market, because they're the ones that have the biggest expertise in operating in those spaces. I think one thing that I would just mention is there was the carbon market people listening for this will know what I mean, but there was a big scandal around mis-selling of a scheme in a country in South Africa, not South Africa, but in Southern Africa. And it was the 195 in the corruption list. And you're going why would the carbon market not have some aspects of fraud going on, but every other industry that operates in that country is totally riddled with issues to do with it? Why would it be different, right? And I guess that's quite a cynical statement, but it's just to sort of say that's the reality sometimes. So back to this idea of being slightly sanctimonious and puritanical, that's kind of what it's like doing businesses in frontier countries. And of course, you can export rules of engagement and export terms of engagement, but also that's the people that need the money the most. And I think that's just, people need to be a bit more realistic about what it means to be doing business in some of these countries. So yeah, it's an interesting challenge. What I would say though is, I don't think that there is a discernible difference between the project quality in the global south and global north. I think actually in many instances and in certain types of projects, there's a higher quality in the global south. And the people that are working in those spaces from LATAM through to sort of Southeast Asia, scientists are very good all around the world, right? And there's loads of amazing institutions, amazing academics and investors and developers everywhere. And actually showing the credibility of the impact in some instances is easier in those countries because they really were under threat, right? Whereas actually showing that in a Midwestern state of the US is harder. And so actually in some elements, it's the way in which you assess a carbon credit lends itself to having a positive spin towards many aspects of the global south. I think the thing that can be trickier is just trying to get some of these large entities to want to buy in those countries. There's a lot of buying behavior, which is the global north for the global north. And often people do want to buy from the country that they operate in. So there's quite a large prejudice often towards local supply, which is totally understandable, but slightly begets the idea that a dollar invested in East Africa is worth a hell of a lot more to that economy than a dollar invested in Eastern United States, for example. So it's a complex issue, right? But just because doing business in some of the world's poorest countries isn't always the most elegant process doesn't mean that therefore it's fundamentally an obstacle to delivering good projects, which I think is also quite an interesting reference point in the market.
So just to go back on something you touched on earlier, I think it'd be really useful for our listeners if you're right in the middle of this market. And for many of us, myself included, it's not completely clear to me how a voluntary market works and a involuntary or compulsory or whatever. Could you just give us the 101 on those two things?
So let's maybe start at the very top, which is paying for your emissions through instruments. There's three ways you can do it. A tax, like you have to pay this tax based on what you pollute, which would be the simplest way to get everyone to pay for their emissions. Two, a cap and trade, which is basically you draw a big circle around a bunch of industries, you calculate how many emissions that they generate. You then say you're going to reduce it by X% every year, and you're allowed to buy and sell those permits based on whether you've beat or you've missed that target. The third way is you try to create physical instruments like carbon credits from an actual intervention. And then the voluntary and compliance pertains to the reason as to why you're buying it. They're the same instrument, they're just a carbon credit. But in a voluntary sense, it's basically traditionally corporates or other organizations, could be individuals, who want to voluntarily buy this instrument to put a price on their emissions and try to address their impact. On a compliance scheme, a bit like in cap and trade scheme, they're mandated to do that from the government, and they have to buy specific instruments which qualify for that regime. Now, they could be the same project. It's just that they, think about two different shops. One you have to walk into and you have to buy what's on the shelf, and one you don't have to walk into, but it's the same thing on the shelf, right? So it could be that that's the case, or it could be that there's slightly different things on the shelves. But this idea of voluntary is quite a weird and quite a hot potato for some people in the space, because buying equities is voluntary. Buying debt is voluntary. You're not compelled to buy anything in a financial market. I do it because I think that there's a potential return or whatever else may be. The carbon credit is the really thing that's important. I think over time, most people think that the two are going to converge. And back to my shop analogy, there'll be one shop, and there may be differences about what you're allowed to do depending on which region you come from or, which industry you work in. But basically, they'll all be the same thing, and you have to just go on that, and you'll be told to by different government institutions. The other way of saying that, by the way, is actually compliance comes from the government mandate. Voluntary typically comes from a consumer mandate. So the traditional reason why people bought those is because they wanted to say that by doing better, they would be able to sell more, generally speaking. And actually, the reason why you had the big scandal in 2013 around carbon neutral was that people were saying, buy me because I'm doing good. And then if you said, well, show me the things that you're saying are evidencing that you're doing good, but those are bad. So you've just said to me you're doing good, and I've just bought you because I thought you were doing good, and actually you're doing not anything or just actually bad. Shame on you. And so you also have this weird thing whereby the buyer in this market can be stung by all of the risk associated with the credit, which is also quite a weird way round. Anyway, so that voluntary is and compliance is about the mandate to buy. The carbon markets means that they're a carbon credit as opposed to an emissions allowance. And the distinction there is emissions allowance is a piece of paper, and a carbon credit is supposed to be backed by a physical intervention.
So then it feels like I've got to ask this question, which is a bit of a trap. So is the voluntary carbon market, the assets in the voluntary carbon market, surely they're lower quality, right?
No, that's not what we find. You've got to think about it like this, that there are a bunch of organizations, I think 30, or the main ones are Vera and Gold Standard. And you got some new ones coming up like Symmetric, which are called standard bodies, and their job is to write methodologies and basically check that you're doing what you say you do. And then you have government organizations that are doing it. But they're all just organizations writing rules and requirements for you to basically evidence what you're saying. There's quite a big distribution amongst them all, from the UN through to the private sector through to the NGO players. And I think we don't find that there is a inherent quality bias towards schemes or credits that comply with government schemes. I originally said to you that they are also the most opaque, so it's also not that easy to assess some of these things. But we're not seeing that is definitely a thing. The thing that is true is that it's a risk transfer. So the risk is on you if you're buying it in the carbon market. The risk is on the government if you're buying it in the government market. And, the government told me to buy them. So what? The people can't see what I'm doing, but I'm shrugging my shoulders. But like it's not my problem, right? Treasury told me to buy them, so I'm buying them. Whereas if you're like, well, no one told you to buy these credits, you did it because you wanted to show that you're doing good, and you're not doing good. So, you bear all of the risk. So I think that the risk transfer element of it is really, really critical as a big positive to the compliance space. But the kind of ceteris paribus quality aspect is definitely, if anything, probably slightly the reverse. We find that the highest quality credits are generally ones that have been coming from what you'd call compliance-based, voluntary-based schemes.
Because you sort of got more skin in the game if it's on you rather than being held to the fire to go and buy these instruments.
Yeah, you've also got 20 years of methodology development in some of these organizations.
Yeah.
And a hell of a lot of, let's say, constructive and destructive feedback on those methodologies. We had one government, I won't mention who they are, but they kind of said, we want to rate some of your domestic compliance credits. And they were like, well, no. Oh, okay, well, normally we just get round you by saying we'll go to the developers and we'll get some of their disclosure. Like, no, we refuse to let them disclose to you. Okay, what if we, under NDA and confidentiality, privately assess some of these things and come back to you and tell you what we found? Cool. Well, we found that they're not very good. Yeah, we're not going to let you in. So also, from our perspective, what's the incentive to some governments letting us come in as a unregulated, hopefully we get regulated, but an unregulated private sector actor, taking their projects apart, comparing them to these more transparent, publicly available reference points, identifying that these government institutions have actually baked these things at a lower quality than the NGOs who have derided, in some instances, by the press. Which respecting civil servant's going to let me in, right? It's like letting the fox in the chicken coop. But that's also, we're also trying to explain that's not what we're trying to do, by the way. We're not trying to be the fox in the chicken coop. We're merely saying that these things should all be compared and contrasted and assessed in the same way. And if your rules are more lenient, then it's fine if no one cares because it's a risk transfer, but don't pretend for a second that they're the best thing since sliced bread, because they're not.
So one of the things that strikes me from watching you over the years and looking on your website is that you spend a lot of time thinking about governance and frameworks, which I guess makes sense, right? If you're going to come in and assess these assets, then you've got to really think about how you do it in this is an emotive word, a fair way, or you're essentially trying to make subjective things objective and comparable, right? So how do you go about that? How do you think about that as a business?
Yeah, and one of our DDs for, I think, one of our investment rounds was so often a question we get asked actually is who's auditing you? Who's telling us that you are you're kosher? So there's that aspect of it. And then on the other side of it, a business model, which you're kind of touching on, is a rating agency business model is a very, very specific business model. And there is a, hundreds of $billion industry for regulated industry in the bond and credit rating space, where the do's and don'ts are unbelievably strict, right? And I used to be a regulated equity analyst, but if you break those rules, you go to jail, right? There's no slap on the wrist stuff, right? This is really serious, regulated practice stuff. And the key thing that you have is that you're independent, and that actually you don't have anything that can potentially cause you to have a conflicted view or potentially create an outcome for a rating which can lead to a prejudicial view for one stakeholder group or whatever. And what we use is, which is, I think, pretty reasonable, is that we use basically all of the building blocks of the financial ratings system. So no buying and selling, no project developing, no specific design advisory, no products like obviously buyer seller matching and these sort of investment support sort of products. Obviously no commission structures, payments, no results-based payments. You don't just get to pay me when you got the result you wanted. You have to pay me up front and you find out afterwards. And then obviously disclosing all the ratings once they're public to everyone, right? And that's the building blocks. There's quite an age-old debate in rating agencies, which is buyer pay versus developer pay. But should the buyer be paying, and that's a less conflicted model, or should you allow issuers to pay? If you look at the regulations and the history of the regulations, and sadly for me, I've read a lot of that, it's about managing the conflicts. There's always potential perceptions of conflicts. If the developer pays you, then surely you're just pump priming the outcome to give them what they want. But I can tell you that my legal fees suggest that they don't always get what they want, and they get very they get very litigious when they don't get what they want. So that's certainly an evidence point that we are pretty independent. On the other side, if you're already long these things and you just want to be told to buy good things, there's just as much evidence showing buyer pay models are just as conflicted as issuer pay models. Because if you're just subscribing to something that tells you what you want to hear, isn't that driving some subscription? So, both of them have potential issues. I think where the regulators in European, FCA, US regulators have come down on is say, right, these are the do's and don'ts. And we apply those ones as they pertain to the financial markets. But, it is different, and maybe they'll come down differently as they get regulated. On the governance point, we're one of the biggest private sector science teams in the whole global carbon market. The team has published, tens of thousands of academic papers across all different disciplines. We've at this point spent King's ransom, a lot of Moulton's money, 70, 80 million on building analytical infrastructure to assess this very niche asset class. That to be honest, do I need to have a professor to we have an advisory panel and they're really good, but that is evidence enough, right? That we have nearly 200 clients paying us to do this work. You think Microsoft is going to keep paying us? Do they think that we're not good at what we do? We are a company that lives and dies by our brand and our reputation. So for me, the whole I've got this scientific advisory panel and they basically rubber stamp what I do and therefore what I do is credible. I think that's inferior to saying I live and die by the quality of the work that I do. I make that quality of work publicly available, and therefore I treat others like I want to be treated myself, which is to say, if you think my view's rubbish, and we definitely didn't nail every view at the beginning, then, we'll be held accountable to that. And, we better fix up sharp and be humble and stay learning and stay engaged in the market, because that's way more important way of building credibility than just basically going, I've got 8 professors who are going to basically tell you that this is good. Because that's a markets-based approach, right? You expose your view, you let all the experts interrogate your view, and then people basically coalesce around whether they agree or not with you. That's for me a way more intrusive and extensive way of having a conversation about the quality of your work than basically going, nothing to see here. Some really great people have done that. And my twist to that would say, but the very people that you might want to get on your advisory panels are the people that I have as staff. So I'm actually already employing those people who would have just been out of universities anyway to do this, but they're just now getting better paid in the private sector by doing they're doing a job than they would have been there. So it's not even like we're going and having bad, so I'm also squaring that circle by hiring very many of those people. But it's a fascinating question. I think our independence is everything. And the quality of our work is always improving because we expose it to so many people, and that allows us to get a lot of sometimes acerbic, sometimes very happy feedback, and the analysts to live and learn.
And Tommy, I want to come on to my final question for you, which is my favorite, which is, what is your contrarian view?
Man United will get Champions League qualifying. Probably quite a good one. What is my contrarian view of the carbon market or of the environmental space? What's the subject?
Yeah. Everything's in scope. Whatever you want. My
contrarian view, fine, a bit more zeitgeisty. AI will take much longer to be adopted in earnest than the kind of urban hype cycle is really suggesting today. It's mispriced because the energy production that goes into it is basically not paying for its true environmental impact. And it's all being subsidized by, equity anyway at the moment. And as that gets repriced, that will slow down the adoption cycle. I think the AI adoption bubble will be slower to be take place than a lot of people think. The other contrarian view would be, and I guess I don't know if this is contrarian, but the politics of the environmental movement is returning. Having hoped for many people, including me, that would be good for the 2020s, it's now emerging as being a very negative headwind, if you will, for the environmental movement.
Actually getting in the way.
Yeah. And actually, net zero is being drawn as a tax, basically, on consumption and on businesses. And I think the contrarian view would be things probably will probably get a bit worse in the short term. But equally, I do think that we're going to emerge from whatever the financial model is that emerges in the next few years with the green economy at its heart, because I don't really see a way out. Basically, the only real way to create new jobs and new growth is to revalue our environmental impact, and that is basically will create and unlock trillions of dollars to actually get people doing things. So that's maybe not that contrarian, but that would be my other one.
Excellent. Well, Tommy, I know you're a very busy man, so thank you for taking the time to speak to us. And if you'd like to learn more about what BeZero and Tommy are up to, do go to their website. There's loads of incredible content on there, and you can click in and see all of these different assets and what BeZero are up to. And if you want to learn more about carbon markets, we're going to do a few more episodes on this in the next 10 or so episodes. So watch this space, and do not forget to like, subscribe, and hit all the good buttons. They mean the world to us. So thank you, Tommy, for coming on and joining us.
Thank you very much for having me.